Hello. Well, good morning or afternoon, whenever you're watching this. My name is Sayf Ben Fraj. I'll be presenting today Monte Carlo simulation for sustainable project risk assessment. This brief is going to be based on the article Innovative Project Risk Assessment using Monte Carlo simulation by Dr. Katerina Tobisová. All right, well, let's get right into it. So the article by Senova, Tobisová, and Rozenberg, 2023, I hope I didn't murder their names, introduces a novel methodology for broad project risk assessment using the Monte Carlo method. It is implemented through Crystal Ball software in Excel, and we'll talk a little bit about it. Focus on Slovak transport companies as a case study where it compares two investment projects, highlighting the importance of probabilistic analysis over traditional methods for better decision making. So, the approach, as this article states, enables companies to assess financial risks, optimize investments, and improve sustainability, offering practical guidance on integrating simulation tools and management processes. So, modern challenges in risk assessment. The article starts with uh, the frame of that in the wake of post COVID economic turbulence and ongoing geopolitical conflicts like the war in Ukraine, Israel and Hamas, Israel and Iran, companies face unprecedented financial risks. So Dr. Tobisová elaborates here on why risk assessment has become so critical for managerial decision making in general in these volatile times. With inflation surging and market unpredictability being at all-time high, even marginal miscalculations in project planning can threaten a company's sustainability. So, risk assessment will allow these managers to anticipate potential losses and make more informed investment choices, thus ensuring the long-term sustainability and stability of the company. So, what happens as businesses increasingly operate in globalized environments? What are the main consequences of neglecting structured risk management proposed by Dr. Tobisová? So, neglect in risk management can lead to cascading failures. Projects may incur unexpected losses, erode profits, or even in worst case scenarios, ending the company in totality, wiping it from existence. Competitors leveraging advanced risk tools will adapt faster to these volatilities in the market and in a geopolitical environment, and they will be widening the gap for those still relying on outdated methods. So, at the core of risk modeling lies a fundamental philosophical divide here: deterministic versus stochastic methods, or stochastic and deterministic thinking, right? Deterministic approaches operate under the assumption that the world is predictable. Each input leads to a single fixed output. It's like driving on a single lane road with no turns, no traffic, and no surprises. You know exactly where you are going and how long it will take. So, this model works well in controlled environments, manufacturing processes with tight tolerances, or engineering systems with minimal external variability. But in business, especially in project finance, the environment is anything but controlled. Cost fluctuates, revenue shift, customers behavior evolve, and external stocks like external shocks, excuse me, like pandemics and geopolitical events can radically alter the outcome. That's where stochastic methods comes in. These approaches, like Monte Carlo simulation, recognizes the variables are not fixed. They are distributions. Instead of assuming a single value for future sales or input cost, we model a range of possible values, each with its own probability. This transforms our analytical from a statistical or from a static, forecast into a dynamic landscape of possibilities. So let's visit an example here. The traffic analogy is a famous one. A deterministic model says your commute will always take 30 minutes. It ignores the variability introduced by rush hour, road closure, or weather conditions. The stochastic method, on the other hand, accounts for these uncertainties. It tells you that your commute could take anywhere from 20 to 60 minutes, and it assigns probabilities to each scenario. This shift in thinking is critical for financial risk assessment. Deterministic models might tell you that a project will yield a 12% return, but what if that estimate is based on overly optimistic assumptions? What if market demand dips or input cost spikes? A stochastic model doesn't just give you one number, it gives you a distribution of possible returns, showing you the likelihood of exceeding your target, breaking even, or occurring a loss. More importantly, stochastic methods or models allow you to quantify tail risks, the low probability, high impact, even that deterministic models ignore. These are the black swans, the outliers, the scenarios that can make or break a project. So, building on that distinction between deterministic and stochastic thinking, we now turn to the tools that operationalize risk assessment, qualitative and quantitative methods. These two categories are often treated as separate disciplines, but in practice, they are deeply complementary. Complementary. Each com- each of them is a complementary of the other, blind spots, and reinforcing the overall robustness of the overall analysis. Qualitative methods are rooted in human judgment, experience, and contextual understanding. Techniques like scenario analysis, SWOT, or failure mode, and effect analysis, FMEA, allow teams to explore hypothetical situations, identify vulnerability, and assess potential impact based on expert insight. These methods are especially valuable in early stage projects, emerging markets, and novel technologies. This is very powerful where historical data may be limited or irrelevant. For example, in an agile transformation initiative, qualitative methods might surface cultural resistance, leadership misalignment, or communication breakdowns. Factors that are difficult to quantify but critical to success. These insights often emerge through interviews, workshop, or cross-functional retrospective. Now let's move on to quantitative techniques. So on the other hand, quantitative techniques bring statistical rigor and objectivity. Methods like Monte Carlo simulation, regression analysis, decision trees, and value at risk VEAR use numerical data to model uncertainty, estimate probabilities, and calculate financial consequences. So these tools are indestructible when evaluating investment decisions, forecasting cash flow, or assessing operational risk. So let's take an example. For instance, Monte Carlo simulation can model thousands of possible outcomes for a capital project, for example, revealing not just the expected return, but the full distribution of risks, including tail events that could threaten viability viability of the project. Quantitative models also enable sensitivity analysis, helping managers understand which variable exert the greatest influence on outcome, or in other words, which risks to focus on. But here, the key, neither approach is sufficient on its own. Qualitative methods capture nuance, context, and emergent risks that data alone might miss, where qualitative methods validate those insights, test assumptions, and provide a defensible basis for decision making. So now, throughout the article, there was a mention of the 5 phases of risk management and how effective risk management is not a linear checklist. It is a dynamic, iterative system that evolves with the project lifecycle. It consists of 5 interconnected phases, each reinforcing the next and collectively transforming risk from a reactive burden into a proactive strategy asset. As we start from the left to the right, following the arrow and down to the left back to the prepare stage. We start by the first of the 5 phases, which is identification of risk, or more accurately, identification of risk factors. So this is the foundation. It involves screening the internal and external environment to identify variables that could influence the project outcome. For example, technical uncertainties, financial exposure, regulatory shifts, stakeholder dynamics, or supply chain vulnerabilities. So identifying these are important. So the identification isn't just about listing risks. It's about framing them within the context of organizational goals, project constraints, and systemic interdependencies in agile environments. This phase often includes team retrospective, stakeholder interviews, and horizon screening to surface both known and emergent risks. So then we move to the second phase, which is assess the significance, or more accurately, assessment of risk significance. So once the risks are identified, right, the next step is to evaluate their potential impact and likelihood. This is typically done through experts' judgment, risk matrices, or sensitivity analysis, where the goal here is prioritization. Not all risks are created equal. Some may have high impact but low probability. Other might have frequent but manageable. By assessing significance, organizations can focus their attention and resources on what truly matter, avoiding the trap of risk paralysis or misallocations of efforts and resources. Now we need to quantify the impact, or quantification of the risk. This phase translates qualitative assessment into numerical models. Techniques like Monte Carlo simulation, decision trees, and expected monetary values analysis are used to estimate the financial consequences of risk scenario. Quantification enable scenario planning, cost-benefit analysis, and risk-adjusted forecasting. It also provides a defendable basis for communicating risk to stakeholders, especially in capital intensive projects where board level decisions hinge on financial clarity. Importantly, quantification doesn't estimate or eliminate uncertainty. It makes it visible, measurable, and actionable. Now, implementation of the risk mitigation, or in other words, preparing the corrective actions here, right? Preparing the corrective actions. So despite the best efforts, some risk will materialize. This phase ensures that when these organization is prepared, corrective actions plans outline predefined responses, who acts, what steps are taken, who communicate flows, and how the communication flows between the parties involved in the action, and how recovery is managed. Now, for the last before the prepare, mitigations or transfer measures, So once we prioritize and quantified risks in hand, organizations can now design interventions. So these may include technical safeguards, contractual risk transfer, process redesign, or contingencies buffers. The key is aligning alignment, I guess, the better word, which is the mitigation strategies must be proportionate proportionate to the risk, and integrated into project flows. So another big factor that the paper talked about in the whole context of risk management is modern risk factors. We talked about risk factors in a couple slides before, but we did not talk about modeling it. So in theory, risk modeling begin with robust data set and statistical precision. But in practice, especially in early stage projects, emerging markets, or innovation driven environments, data is often incomplete, either outdated or simply it's not available. So you ask yourself the question, how do companies determine which risk factors are most significant when hard numbers are lacking? The answer here lies in programmatic blend of expert judgment and sensitivity analysis, both of which serves as powerful proxies for data-driven insights. You have the expert assessment on the left, which can be managers, engineers, and domain specialists, which often possess deep tacit knowledge, insight, drawn from experience, pattern recognition, and contextual awareness. In the absence of empirical data, this expertise becomes invaluable. For example, a product manager might flag regulatory uncertainty as a high impact risk based on recent policy shift, even if no formal data exists. A supply chain lead might anticipate raw material volatility based on supplier behavioral patterns. These insights often surface risks that quantitative models would miss entirely. Now, on the right side, sensitivity analysis is here to complement the expert judgment. Sensitivity analysis offer a systemic way to test how changes in input variables affect key outcomes by adjusting one variable at a time. So as energy costs, labor rates, and sale volumes uh, are being adjusted, we observe the impact on profit margins or delivery timeline, or organizations can identify which factor exert the greatest influence. So let's take an example. If we can consider this example, a 10% increase in energy prices resulted in a negligible dip in profit, suggesting that energy cost is a low priority risk, but a 5% decrease in sale price, however, caused a dramatic drop in profitability, which is an indication that the price strategy is critical risk factor. This kind of analysis doesn't require perfect data. It requires a working model, a willingness to explore what if scenarios. It's especially useful in Excel-based environments where tools like Crystal Ball that we're going to talk about later, referred to by the author in the paper, can automate simulation and visualize outcomes. All right. Now let's take a closer look at Monte Carlo method, one of the most powerful tools in the modern risk analysis toolkit. So at its core, Monte Carlo simulation is about embracing uncertainty, not avoiding it. It allows us to model complex systems where multiple variables interact with each other with its own degrees of unpredictability. Instead of relying on fixed input, Monte Carlo uh, treats uncertain variables like sale volumes, cost, market demand as probability distributions. These distributions can be normal, triangular, uniform, or custom shape, Poisson, whatever, based on historical data or expert judgment, as we discussed prior. The simulation then runs thousands or even millions of iterations, randomly sampling values from these distributions and calculating the resultant outcome. The result is not a single forecast, but a distribution in its own of possible outcomes, a full spectrum of financial results, each with an associated likelihood. Let's think about it like rolling a pair of dice thousands of times. You don't just get the average roll, you get the full picture. How often you roll a 7, how rarely you would roll a 2, a 12, whatever number, and what the implications are if you do. In financial terms, as stated in the paper, this means understanding not just the expected profit, but the probability of exceeding targets, breaking even, or increasing loss. So we ask ourselves the question then, why is this so powerful for project risk assessment? So because real world projects are rarely linear or predictable. They are influenced by fluctuating markets, evolving customer behavior, supply chain distributions, etc. So traditional models often build to handle an environment that is predictable, uses fixed inputs and produces a single point estimate. This best guess approach is deceptively simple and dangerously optimistic. It ignores the tail of the distribution, the rare but high impact events that can derail a project or create unexpected windfalls. These are the black swans we talked about earlier, the scenarios that matter most in strategy planning. So Monte Carlo simulation, by contrast, makes the uncertainty visible. It quantifies it, the likelihood of extreme outcomes and allow managers to plan for them. It supports risk adjusted decision making, where choices are evaluated not just on expected return, but on volatility, downside exposure, and strategic fit. In short, Monte Carlo simulation transforms risk modeling from a static forecast into a dynamic decision support system. It empowers organizations to move beyond intuition and into evidence-based strategy where uncertainty is not feared but modeled, measured, and managed. So how would the paper goes about the integration of these methods or Monte Carlo method? And is it simple for the common person to implement? So the paper goes into the integration of Crystal Ball and Excel as a simulation transitioning to tools. So they talk about how software like Crystal Ball integrate with platforms such as Excel to facilitate Monte Carlo simulations. Crystal Ball acts as an add-on on Excel, allowing users to define variables as probability, distributions, say sales, for example, as a normal distribution, reflecting market volatility. The software automates thousands of simulations or cycles with a spreadsheet and outputting a histogram, sensitivity analysis, and risk profile with minimal manual setup. So it actually lowers the barrier of sophisticated risk analysis, making it accessible even to those without advanced programming backgrounds. This accelerates the adoption of small and medium-sized businesses looking for a way to modernize their risk management and move away from the traditional methods. So one of the important things in this paper is the illustration of how important this to risk management through a case study. The case study they depict is the investment decision in Slovak transport sector. It was illustrated as the real world example where the company evaluated two options here. So the first option is a 47,000 euros sheet metal ringer, and And the second option is an 88,000 euros welding machine. So both with a 12 years lifespan. However, if you go with a face value, without any information, you would probably pick the um, lower value. However, by modeling revenues, costs, and tax impacts in Excel, and in this case, using Crystal Ball, running Monte Carlo simulations, they assessed the full risk return profile for each, as seen on the right side. So what did the simulation here revealed is that traditional analysis might have missed is that Monte Carlo outputs showed that despite higher potential profits in the welding machine scenario, the risk is significant losses was also greater. The sheet metal ringer offered a more favorable balance of expected returns and risk, leading to more confident investment decision. That is the power of the Monte Carlo simulation. All right. So actually, more charts um, and visualizations they can be used actually to give you more insight out of uh, this data that was spit out from the crystal ball Excel integration. So a tornado chart is one of them, and a tornado chart ranks risk factors by their impact on outcome. So in which variable drive the most volatility? So if you see here, we have the example of two, one is fixed cost and one selling price, where you see that the selling price here is more impactful. It's basically a bar chart where the longest bar matters most. To the right side, a spider chart. A spider chart, meanwhile, plots how outcome changes track with varying input values. So it highlights nonlinear effects of interactions. So for both here, the visualization actually helps managers quickly grasp where to focus their attention here. So how in practice these charts influenced the example we had before of the case study. So they revealed that the fixed cost, as you see on the left side, and the selling prices were the dominant risk drivers. This insight allowed the company to target these factors in negotiations and operational planning, rather than disparate efforts across less critical risks identified. All right, we're getting close to the end of the brief here, but we want to touch a little bit about a important portion of the paper, which is interpreting the simulation results, right? If you don't know how to interpret your results, the simulation is useless. Can't do nothing with that information. So once the Monte Carlo simulation that we discussed earlier is complete, the real value, actually, as I said, lays in how we interpret the results. So the raw outputs thousands of simulated outcomes. They need to be distilled into key statistical indicators. We've seen a couple of charts before. So these metrics don't just describe the data, but they reveal the underlying risk dynamics of the project. So let's break it down of the most critical indicators here. If you took statistics, this will be familiar. So the mean and the median. So the mean and the median, these represents the central tendency of the simulated outcome. Essentially, the expected profit or return. The mean is the average across all simulations, while the median is the midpoint. In systematic distributions, they are close, but in skewed distributions, the gap between them can signal asymmetry and risk. So what does that all mean? So let's use an example. So if the mean profit is $100,000, but the median is $80,000, this suggests that a few high profit scenarios are pulling the average up, while most outcomes are lower. This nuance is crucial when communicating with stakeholders who may be misled by optimistic averages. So, standard deviation is also important because it measures the volatility or spread of the outcomes. A higher standard deviations mean greater volatility, more uncertainty in the results. In risk terms, it is a proxy for unpredictability. So two projects might have the same expected return, but if one has a standard deviation twice as large as the other one, it inherently riskier. This affects everything from budgeting, contingencies, planning, to investors, and even the confidence of these investors. The third one is skewness. Um, and what skewness reveals is the asymmetry, as we discussed earlier, of the distribution. But how do you interpret it? Here, a positive skew means there is a long tail on the upside, potential for windfall gains, where a negative skew means the tail is on the downside, greater chance of significant losses. In our case study, the welding machine project had higher profit potential, but also negative skewness, indicating that while big gains were possible, the likelihood of disappointing returns was higher. This is a red flag for risk-averse organizations, or those with limited tolerance for financial shocks. Um, Another factor is the coefficient of variation. So this is the ratio of the standard deviation to the mean. It is a normalized measure of risk per unit of return. It's especially useful for comparing projects with different scales. So a lower CV means more predictable returns relative to expected profit. So in our case study, the company chose the project with a lower CV, prioritizing stability over maximum upside. This reflects a mature, risk-adjusted decision-making approach. So to wrap this up, most importantly, this approach on how to interpret the data, right, ensures that managers don't chase the highest possible return blindly. Instead, they weight potential rewards against the likelihoods and the magnitudes of adverse events. So, this is the essence of sustainable growth, making decisions that are not just, tailored to profit, but resilient based on risk assessment. So, in volatile environment, this kind of statistical literacy become a strategic asset. It is inevitable and it enables organization to navigate uncertainty with confidence, agility, and forecast in hand. So, in closing, and to wrap it all up, what are the main challenges and opportunities for wider adoption of the probabilistic risk management methods like Monte Carlo simulation that we focused on in business practices? The primary challenge is cultural, to be honest. Many organizations are hesitant to abandon familiar deterministic models. They got used to it. They don't have the tools established. A cultural resistance of the workers. Sometimes even the managers themselves, right? Well, mostly the managers themselves are resisting. There's also a learning curve to all of this for both managers, analysts, workers. However, as we've seen today, as the software becomes more user-friendly, and the value of scenario-based planning is proven, the paper makes the expectation that broader uptake will be coming soon. Ultimately, integrating probabilistic tools will foster a corporate culture that value resilience and informed agility. So, from my perspective, I learned a little bit that there is hope that these discussions will encourage more organizations to invest in modern risk management and empower their teams to make smarter and more sustainable decisions. Well, we get to the end of the brief. Thank you. I hope to see a lot of you comment and leave questions. Thank you.